Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Hey, this is Stan the Annuity Man, and welcome to Fun with Annuities. Today we're going to talk about QLACs. What is a QLAC? A QLAC is a qualified longevity annuity contract. Now, I've written books on all of these products, and I'm actually holding in my hand. You'll hear pages flip because it's a great outline for this podcast. I've written a QLAC owner's manual. I've written owner's manuals on all product types, and I encourage you to go to my site at theannuityman.com and get for free, no obligation, I'll ship it to you in the mail, a QLAC owner's manual, or you can go to Amazon and download the Kindle, whatever you want to do. But you need to read it because that's where this is all coming from, because I've synopsized it into like a 55, 60-page, easy-to-read owner's manual that covers everything. So with all products, I start with limitations. I'm the only one that's not starting with the sizzle. I start with the steak. And let's start with the limitations of a QLAC. And a QLAC is, in essence, a deferred income annuity. That's another product type, but a deferred income annuity, DIA, is a longevity annuity. And a QLAC, qualified longevity annuity contract, is a deferred income annuity. It's the same exact structure. There's just different, you can only use it in one place. And with a QLAC, you can only use it in a traditional IRA. I think the government's trying to help you do that within 401ks, et cetera. But for now, it's in traditional IRAs, which is great because you can use your IRA for a future pension income stream. But let's talk about limitations because we always start there because that's in the back of your mind anyway. So let's start with the limitations. Lack of liquidity. Just like a deferred income annuity, which is, that's what it is. You can't change your mind, pivot, and say, oh, by the way, Stan, 5 years down the road, I've decided not to do that in my IRA. Send me the money. You can't. It's irrevocable. Meaning you're going to get your money back through payments, but you can't get it lump sum. I think the IRS did that. By the way, and we'll go through where this all started. The IRS and the Treasury developed it, but we'll talk about that in a second. But they didn't want people to pivot like that. They wanted people to create lifetime income streams other than depending solely upon Social Security. There's no growth inside of a QLAC. In other words, if you defer it for 5 years, there's no trackable interest rate, just like a deferred income annuity, same thing. That might drive you crazy because you're an investor and you like to see growth and you're the best investor in the world and you see growth all the time. That's a joke. QLACs are transfer risk income products. The longer you allow an annuity company to hold onto the money, the more they're going to pay when you start the income stream. But there's no trackable interest rate. So if you die before the income starts, let's say, hey, defer my QLAC, I'm 72, defer it, and let's start it when I'm 80. Let's say you die at age 77. 100% of that initial premium goes to your beneficiaries, but there's no interest rate growth. And that might drive you crazy, but you need to know that limitation. It's a rigid contract, so there's no cash surrender value, and there's a limitation on how much money you can put. At the time of this recording, you can take 25% of your total IRA assets, all of it, or $130,000, whichever is less. Let me repeat that. 25% of your total IRA assets, or $130,000, whichever is less. If you have $1 million, $130,000, right? If you have $750,000 in your IRA, $130,000. If you have $400,000 in your IRA, $100,000, 25% of $400,000, right? So 25% of your total IRA assets, and that could be everything from 401ks, 403bs, traditional IRAs, rollover IRAs, all of it combined, 25% or $130,000. And that's for each person. So you and your spouse could do a QLAC if you both have IRAs or qualified type accounts. But I think that's going to go up in the future. It should. But for now, those are the rules. And right now, they're optional for some of the 401k plans, not all, which it should be all. But when they were developed, and we'll talk about when they were developed for the 401k type plans. What's happened is the traditional IRA holders are the ones that are taking advantage of QLACs. My opinion, QLAC should be the number one sold annuity type in the country. What's limiting that is low commissions, which who cares? I mean, it's about you, not the agent. even though commissions are built in and you never see them because this is a simplistic product, it's low, but it should be the number one product sold because there's trillions and trillions of dollars in IRAs and people all need additional income, most people, and this is a great place to go. You cannot use a QLAC inside of a Roth. That's a limitation. So just understand that there's some limitations on where you can use it and how you can use it and how much money you can use. Those are limitations. But let's talk about benefits. It's principal protected. Obviously, 100% of your money we can structure so that, if you die before the income starts or if you die after the income starts and you hadn't drawn down all that money, even though it's a lifetime income guarantee, 100% of that money can go to the beneficiaries if we structure it correctly. Once again, it's a transfer risk. It's a longevity solution. It's a transfer risk to the annuity company to pay you or you and your spouse for the rest of your life. In my opinion, one of the greatest benefits about QLACs is that you can add your spouse or significant other partner to the payment stream, and it's your IRA. That's neat. That's good. That is a way to take care of that person. And I really think a lot of people are utilizing QLACs to take care of their spouse. It's very simple and easy to understand. I always tell people don't buy an annuity unless you can explain it to a 9-year-old. No offense to 9-year-olds, but it's the Warren Buffett rule. If you don't understand it, don't buy it. QLACs are very simple and easy to understand. The payments are primarily based on your life expectancy at the time you take the payments, not interest rates. So don't be an interest rate fool and try to time it, because in essence, you're timing your life expectancy. Good luck with that. So if you say, hey, I'm going to wait another year, okay, great. You're going to be older, so the payments will be higher, but you're also going to miss out on that deferral time period of where they enhance the payout the longer that they hold on to it. You don't have to put the full 130 or whatever, the 25% into a QLAC. You can ladder it. You can buy X amount this year and X amount the next year and X amount the following year, just as long as you stay within that limitation under the rules. You can add a cost of living adjustment rider with QLACs, a COLA, which sounds great. By the way, you already own the best QLAC on the planet. It's called Social Security, and that increases. That increases at the whim of our beloved and smart politicians. But when annuity companies tell you they're going to increase the income every year, they're going to lower the initial payout. In other words, if you compare a QLAC quote with and without, the same one, with and without a cost of living adjustment increase, the one without is going to be higher, and you're going to have to factor out, and hopefully we'll have this discussion, you have to factor into that decision, does it make sense to have the static payment, or does it make sense to have a cost of living adjustment increase and wait those years to make up the difference? Or do I ladder it and buy one with and one without? There's no good remember, there's no perfect answers with annuities, just bad sales pitches. We don't pitch. I'm going to give it to you straight, brutal. You're going to understand it going in. So there's going to be no fluffing things up. So those are the benefits. So we always start with limitations, then we talk about benefits. So let's go back into the product and talk about the history of QLACs. 2014, our friends at the IRS and the Treasury Department, and they are our friends, right? They developed the QLAC. And the sole reason, and I think it's a shot across the bow and a wake-up call, is they want people to start planning for income, period. The money you put into a QLAC, it lessens your RMDs. So in other words, if you put $130,000 in a QLAC and you have a $500,000 IRA, then you're going to take RMDs off 370. Does that make sense? So 130 minus the 500. So the QLAC premium amount is not used to calculate the RMDs from the non-annuity amount. So that is also a really good deal. Not huge. You're going to find the savings aren't great. They're not pounding the table, hey, I'm beating the IRS, but it's legal. So it's another benefit. But in essence, the Treasury Department and our friends at the IRS said, hey, you can lower your RMDs if you plan for future income. So here's our carrot, if you take the income stick, right? If you decide to put a QLAC in place for future income, and they're hoping people do that with the trillions and trillions and trillions of dollars in IRA assets to lessen the blow and lessen, the dependency on Social Security. Because Social Security, as we all know, was not put on the planet as the sole source of retirement income. It was supposed to enhance or be a help, but that certainly isn't the case for a lot of people, unfortunately. And if you're fortunate enough to have a large enough IRA, I would consider taking advantage of the RMD savings, right? Because it doesn't count as a part of the calculation, and also for a future income stream to combat against inflation. There's no annuities out there that perfectly combat against inflation. The way to combat against inflation is to have more income coming in when inflation hits, right? So QLACs can be part of that. So that's where it started in 2014. Interesting enough, when it came out, I thought it was such a good product and such a great idea, and I thought it'd be the number one product in the country immediately. Of course, I didn't factor in the fact that there was low commission and agents wouldn't care, or advisors didn't want to sell it to their fee-based accounts because they couldn't charge a fee on it. I didn't factor that in. I just was thinking like a consumer. Okay, from a consumer, this makes total sense. I still think it should be the number one sold product out there because everyone with an IRA, traditional IRA, or qualified money should quote it. Every single person, everyone, because we're all going to need income in the future. We're all going to need more income, and we're all probably wanting to take care of our spouse or significant other partner in a way that we can with an IRA. And most of people's assets are in IRA money. So I just think it's a no-brainer. And it forced me to write my first owner's manual. My first owner's manual that I wrote, and I've written 6, was on QLAC. And I heard about it. Great story. I heard about it, read about it. I was in Chicago speaking. I literally locked myself in a room and wrote the owner's manual based upon the information I had, and then I enhanced it and I published it, and I kept writing owner's manuals after that on all product types. But that's what forced me to write these owner's manuals. And you should get one. I'm holding the QLAC owner's manual in my hand right now, so you should go get yours as well. So it started in 2014. You know, as I said, the limitations are currently 25% of your total IRA assets, or 130,000, whichever is less. That's per IRA. So you could have one, your spouse or significant other / partner could have one. So the payments are calculated primarily based on your life expectancy at the time you take the payment, not interest rates. So I know that everyone's watching the 10-year Treasury, and everyone says, well, rates can't get any lower, that's not true. Okay, we've all seen that. We don't know. Nobody knows. If people knew where interest rates were going to go, it'd be a much more happy world out there. And there's nobody that actually knows. So you buy it for the contractual guarantee based on your life expectancy. And again, there's no return on investment. There's no ROI till you die, as I say, because it's a transfer risk. If you live forever, the annuity company, are on the hook to pay regardless of how long you live. So going back to the deferred income annuity versus the QLAC, they're the same product. The rules for the deferred income annuities, you can defer it up to age 70 and a half before income starts. You can say, hey, Stan, I want the income to start at age 70. Once we go past into the 70s, then it really becomes a QLAC from the standpoint of income later, an income later type calculation. So remember, it's exactly the same structure as a deferred income annuity, which is exactly the same structure as a immediate annuity. There's no moving parts, there's no annual fees, there's no market attachments. It is what it is. It's a future pension guarantee transfer of risk. And to me, it's part of the overall income floor. Meaning, okay, I have a pension I'm getting from my company if you're so fortunate. I have an income stream coming in from other sources. I have my Social Security that I can hopefully depend on. I think we can, hopefully. And then I'm going to have, either an immediate annuity, a deferred income annuity, or a QLAC that's also going to provide income. Because at the end of the day, when we all retire, it's all about lifestyle. It's all about taking care of our family. It's all about an income stream that's showing up every single month, regardless of what happens in the political world, the financial world, etc. You want that guaranteed money hitting your bank account every single month. So I think that the QLAC is a game changer for people that are IRAs. If you have an IRA and you still say, I really don't need income, you still need to quote it. You need to quote it for your spouse. The other rule that I want to point out is the farthest right now that they will allow, the annuity companies and the IRS and the Treasury will allow you to defer is up to age 85. A lot of people think that I have to defer to age 85. No. With a QLAC, you can defer as short as age 71, or 70 and a half to 71, and as far out as age 85. Okay? Similar to a DIA, because it is a DIA, you can typically change, depending on the structure you choose, change the income start date one time after the policy is issued, if needed. Obviously, if the younger you are, the lower the payments. The older you are, the higher the payments. But you have to understand that you have to play within the rules, and you can defer as far out as age 85. So, during that time period, let's just say you're 75 and you defer to age 85, that amount that you used in the QLAC from age 75 to age 85 is not going to be part of your RMD calculations. The income stream derived from the QLAC, when it does start paying income, covers that QLAC dollar amount asset in full for the RMDs. You can't use that income stream that you're getting from the QLAC, any overage from that, to apply to any non-annuity assets, if that makes sense. It only covers the let's just say you put 130 in a QLAC, you're getting income stream from the QLAC. That income stream covers that RMD for the QLAC, but it doesn't cover anything else, any overage from there. So with that, remember, with the two questions, what do I want the money to contractually do when I want those contractual guarantees to start? With QLAC, what do you want the money to contractually do? I want income for either me or my spouse. You don't have to set up jointly, but most people do if they have a spouse that's still alive. And then when do you want it to start? It can start as early as age 71 or as late as age 85. So if that makes sense, it's really a great product. I mean, I'm telling you right now, I think it should be the number one product out there. And I think that everybody that has an IRA should get a quote. And it's very simple. You're going to get a quote and read the book and make your decision, right? And there's no way to time it, unfortunately. I wish there was. There's not. You can ladder it. Remember, you can do that. So with that, let's end the podcast with some frequently asked questions. And remember that you can go to my blog at theannuityman.blog or theannuityman.com, and you can get there. And what I've done with the frequently asked questions is a lot of people have asked me questions in the past. I've written them all down, and I've gone in there and I'm starting to build this huge inventory of frequently asked questions, of which I answer in an audio format. So you'll read it, you'll hit the play button, you'll hear me answer it very succinctly and shortly, and etc. And you can even put in your own questions as well if you have questions that you have. So let's go through a few, and this is in the back of the QLAC Owner's Manual. You might hear me flipping the pages. Of course, you need yours, right? So go to my site and order it, and I'll ship it to you. So some of these questions might be repetitive. I might have already covered them, but let's go through them quickly anyway. I'll kind of pick and choose which ones to do. How long have QLACs been around? Since 2014. Like I said, our friends at the IRS and the Treasury introduced it. I love it. I think it's one of the best things that's ever happened. Obviously, I want the $130,000 amount to go higher, but that's the limitation, 25% of your IRA total assets or $130,000, whichever is less. People always call me, hey, Stan, do I have to defer as far as age 85? No, that's the longest they will allow you. At age 85, you have to turn on the income stream, but you can defer it as short as age 71, right? So the other question I get all the time, when's the perfect age to buy a QLAC? There's no good answer to that. There's no age range. There's no pie chart. It's when you want to lock in future income using your IRA for you or you and your spouse or you and your partner. It's that simple, okay? So there's no perfect answer. There's just bad sales pitches. There's no ROI on these things. What's the ROI, Stan? There's none until you die. It's transfer of risk. If you die before the income starts, you get your money back. We can structure it like that. I'm going to encourage you to, unless you convince me otherwise, to just say, hey, Stan, I want a QLAC, just life only, and when my Learjet hits the mountain, I don't care. That's fine too. But 99% of the people want to make sure that that hard-earned money that's been trickling into their IRA is a lifetime income stream guarantee, but also will guarantee that if they die early, the money will go to their beneficiaries. People always say, how much money am I going to save on my RMDs? Remember, that amount of money in a QLAC is not used in your RMD calculations. I will tell you right now, the sole reason to buy a QLAC should not be to lower your RMDs, because you're not going to see a significant pound-the-table amount. The main reason is, I think, two. First and primary is you can add a spouse, okay, or a significant other to the income stream using just your sole IRA. The second reason is to combat inflation, having income starting at a future date to combat inflation. Those would be the two primary reasons, in my opinion. The RMD savings would be the third. It's not great, but it's legal, and it's a way for you to lower those RMDs using a tool that the IRS and the Treasury have approved. People always want to know if the premium limits will be raised in the future. Yes, I think so, but anytime they do that, the IRS is probably going to kick and scream a little bit because that's going to give them less tax revenue, because if everybody that has a QLAC is putting more money in it, that's less revenue to the IRS because that's not used in the RMD calculations in the short term. Long term, I think they win. Short term as well, Washington, D.C. is one big short term, right? Unless you're a politician, and then you're in there forever, right? But it's a short term thinking that they have up there instead of long term. And I always say, if it's pro customer or pro consumer, I'm not sure it's going to go through. That's sad to say, but in DC, it's all about tax revenue. Currently, people say how many carriers offer it. I'm gonna say ballpark 15 to 20, ballpark. And why don't all carriers offer? I don't know. They should. I think it's the best product, in my opinion, out there. And when I say that, it's a DIA, it's a SPIA, it's the same structure. But so many people, the majority of people out there, most of their assets are in their home or in their IRA. So, this product should be quoted. I think it should be quoted in every single IRA. If I was running a brokerage firm, my previous life, I was with, Morgan Stanley and UBS and Payne Weber D. Winter. If I was the CEO of one of those companies, I would make every single person, every single advisor quote it. Now they won't because they can't charge a wrap fee on it, right? So, again, it's good for the consumer, but it's probably not going to happen. Also, what are the annual fees? Remember, there's no annual fees. Commissions are paid. There's no annual fees, but there's a commission paid, a one-time commission to the agent by the carrier that you'll never see, and it's low because it's a simple product. So with that being said, that's pretty much a QLAC, a qualified longevity annuity contract. I'm going to encourage you once again, I'm going to pound the table, and the only pound the table I'm going to do is encourage you to get more information. Get the book, get a quote on my site, theannuityman.com. You can get both. And we will treat you like a professional. We will leave you alone. We will provide as much information as humanly possible. And if you want to engage us, you're going to engage me, okay? Set an appointment with me, and I will talk to you, and we will go over it, good, bad, the ugly, limitations, benefits, and you can make a good decision, knowing that you're making a decision on your time frame, and there's never an urgency to make a decision on an annuity because it's a contract, right? So with that being said, I really appreciate you tuning in, and I hope you keep tuning in because I'm going to keep going over products and digging down into strategies, and you're going to learn a lot, and you're going to learn whether these things fit with your specific situation. And I hope you dig in deep with the information that I provide, and contact me anytime. My email, by the way, is stan@theannuityman.com, so you can do that as well. And with that, this is Stan, the Annuity Man. Thanks for listening to Fun with Annuities. See you next time. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MYGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 Annuity Owner's Manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.